Bismillahirrahmanirrahim. This is the third video on financial statement fraud. And in this video, we are going to talk about the framework for detecting financial fraud and the fraud exposure rectangle. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with detecting financial statement fraud. So identifying fraud exposures is challenging and requires a deep understanding of the organization's operations, industry dynamics, management motivations, and external relationships. Investigators must anticipate potential fraud schemes and consider how perpetrators might conceal their actions. In order to detect fraud, investigators should use strategic reasoning. Uh, this involves asking questions like what type of fraud might be used, how could these schemes be hidden from typical tests, how can tests be modified to detect concealed frauds. Then financial statement fraud involves analyzing changes in financial data over time and comparing them to real world activities to reveal inconsistencies. For instance, in the ZZZZ best case, comparing reported financials to actual projects uncovered frauds. Non financial performance measures like facility counts versus revenue can signal fraud risk. There are several non financial performance measures like customer conversion rate, that is the percentage of interactions with customers that result in a sale, retention rate, that is the portion of consumers who remain customers for an entire reporting period, contact volume by channel, that is the number of support requests by phone and email. This allows the organization to not only compare which method customers prefer, but also to track the number of support requests month to month. A salary competitiveness ratio, the competitiveness of compensation options, employee productivity rate, workforce efficiency measures over time. So, all these are examples of non financial performance measures. Next, let us talk about the fraud exposure rectangle. The fraud exposure rectangle framework encompasses management, uh, external relationships, industry and organizational nature, and financial performance, offering comprehensive approach to fraud detection beyond traditional financial statement analysis. Let us talk about each one of them, and we start with the management and the board of directors. Now, financial statement fraud typically involves top management and is committed on behalf of the organization rather than against it, unlike embezzlement or misappropriation. Therefore, investigating management and the board of directors is crucial to understand their involvement and motivation. To detect financial statement fraud, effectively, it is essential to comprehend management's background, motivations, and influence in decision making within the organization. Understanding these aspects is as vital as analyzing the financial statements themselves. So, let us talk about the first one, management's background. So, understanding the past affiliations and situations of management and directors is crucial. One can utilize online resources like Google or search engines to gather information on individuals. Look for past affiliations and corporate reports filed with the SEC. Check for any mentions or articles about the person. Uh, the organization can consider hiring investigative services to conduct more in depth search if necessary. And some of the classic examples of frauds are like the Lincoln Savings and Loan Fraud case, where Charles Keating was involved in the fraud, who had a history of SEC, who had a history and then SEC sanctions related to financial institution frauds were against this gentleman. Then CEO in the case of comparator system case, CEO Robert Reed Rogers had a background marked by dubious business practices and legal issues. Despite claims of achievements, his past involvement in failed ventures and lawsuits was undisclosed. Understanding the motivations of directors and management is crucial for detecting potential financial statement fraud, and some of the key points to be considered are personal investment, that is, if the personal assets of the directors are tied to the organization's performance. Uh, are they under pressure to meet unrealistic targets? Is their compensation largely tied to performance metrics? Do they consistently guide expectations higher? Have they grown through acquisitions or internal means? Are there debt covenants or financial measures they must meet? Is management job at financial risk? Then the second investigation focus for management and the board of directors is the management's motivation. So, financial statement frauds often occur when management needs to support stock prices, show positive earnings for stock or debt offerings, report profits to meet regulatory or loan requirements. Understanding these motivations help in assessing the risk of fraudulent behavior and taking preventive measures. The third investigation focus is management's influence. Understanding how management influences decisions within the organization is crucial for fraud prevention and detection. For example, in case of centralized decision making, fraud is easier when a few individuals hold primary decision making power. In contrast, organizations with more democratic leadership structures make fraud more difficult. First time offenders find it challenging to be dishonest alone, making collusion less likely. Fraud becomes more difficult in organizations with distributed decision making or active boards. Smaller organizations with concentrated power or rapid growth are more prone to fraud. Then, active involvement of the board of directors and audit committees deter fraud. Corporate governance standards like those set by Nasdaq and New York Stock Exchange emphasize independence and oversight. Then, fraudulent schemes often align with the nature of business operations. Management decision to commit fraud influences the choice of schemes and their financial impact. Let us move on to the second component of fraud exposure rectangle, that is relationship with others. Now, relationship with others in fraud, in financial fraud, is prevalent, and financial statement frauds often involve complex relationships with other entities, both real and fictitious, to deceive stakeholders. Understanding these relationships is crucial for fraud detection and prevention. Like Enron's use of special purpose entities. Now, Enron misused SPEs to conceal liabilities and inflate profits. A special purpose entity is a legal entity created to fulfill narrow, specific, or temporary objectives. SPEs are typically used by companies to isolate the firm from financial risk. A formal definition is the special purpose entity is a fenced organization having limited predefined purposes and a legal personality. Radar and Chiuco were key SPEs involved in Enron's fraudulent activities. Enron utilized Radar and Chico to manipulate financial statements and conceal the debt. Although these entities were not truly independent and should have been consolidated with Enron's financial statements. Radar They used personal loans from Fasto and manipulated investments to control a wind farm. Chico received funds guaranteed by Enron to purchase JD, controlled by Enron insiders. In case of Lincoln Savings and Loan, they used sham transactions with straw buyers uh, to mask negative performance as profitable. Now, sham transactions, these are the transactions that are made to mislead or deceive others. It is a transaction having no economic effect that is made to create tax benefits. While straw buyers is a person who makes a purchase on behalf of another person or group, which might be done as part of a fraud scheme to mask negative performance as profitable. So, structured fraudulent transactions with bankers were made to conceal mortgages on real estate properties. In case of ESM government securities, they hid a 400 million financial statement fraud using related parties to create a large receivable. In examining relationships to uncover management fraud opportunities, focus on various parties including related organizations, external auditors, lawyers, investigators, and regulators. Additionally, consider relationships with financial institutions and bondholders to assess the company's leverage. Key questions to ask about debt relationship include company leverage, that is, determine if the company is highly levered, and identify the financial institutions involved. Pledge assets. Understand which assets of the organization are pledged as collateral for debts. Determine if there are any debt or restrictive covenants that must be met by the company. Assess if the banking relationships appear normal or if they are unusual associations with financial institutions, such as using institutions in uncommon geographical locations. And then investigate if there are any relationships between the officers of the financial institutions and the client organization. Let us now move on to the third component of fraud, that is organization and industry. Now, financial statement fraud are often concealed by complex organizational structures. Examples include Enron's non consolidated SPEs and Lincoln's savings and loan deceptive transactions. In case of Lincoln Saving and Loan case study, Lincoln, a subsidiary of American National, had over 50 related entities, some serving no apparent purpose, fostering opportunities for fraudulent transactions. For instance, Lincoln orchestrated seemingly profitable land sales to straw buyers, providing simultaneous loans to fund down payments, blurring transactional clarity. In case of ESM fraud, they used related entities to fabricate receivables, masking their inability to pay. Fraud prone organizational traits include complexity, lack of internal audit, insider dominated boards, offshore entities without purpose, and weak controls. Small firms, often lacking robust internal controls, are particularly vulnerable to fraud, necessitating vigilant audit committees. Industry risk varies greatly. For example, saving and loans in the 1980s were risky, while technology firms face high fraud risk. Assessing industry's performance and asking the right question can reveal fraud risk, like is it overly complex with unclear purposes? Are insiders dominant and is the board passive? Are outsiders prevalent and is the committee active? Is it independent and active? Are they purposeful? Is there fierce competition on rapid technological change? Is it in line with the industry peers? And any pertinent concerns regarding organization and industry. The fourth component of fraud is the financial results and operating characteristics. So let us look into the fourth component. So, examining management, the board of directors, and organizational relationships is crucial for understanding financial statement fraud. Consistent procedures for examinations. Regardless of the type of fraud, the same procedure applied to analyze these elements, whether it's revenue, assets, liabilities, expenses, or equities being manipulated. A thorough examination of these aspects help uncover potential fraud. Exposure to financial statement fraud varies based on the organization's operating characteristics. A non traditional approach is necessary to assess fraud exposure effectively. Recognizing fraud symptoms often manifest as changes in financial statements. Large fluctuations in account balances indicate potential fraud, especially compared to small incremental changes. Sudden significant increases in receivables can signal fraudulent activity. Footnotes provide crucial insights into financial statements. They often hint at potential fraud but may not be clearly understood by auditors. Understanding footnotes is essential for uncovering hidden fraud indicators. Compare the balances with similar organizations in the same industry. Determine real world references for financial statement amounts. For example, if financial statements report 2 million of inventory, ensure it aligns with physical storage, equipment, and personnel required. Understanding the client's business nature and relevant accounts is another way. So, identify potential fraud types and associated symptoms. Example may be like major activities in manufacturing include sales, collection, acquisition, financing, payroll, and inventory management. Then, proactive fraud detection, that is, break down the organization into cycles, identify major functions, inherent risks, and potential fraud. Use proactive techniques for fraud detection. The non financial performance measures complement the financial analysis with non financial indicators. For example, balance scorecard evaluates financial and non financial metrics like customer satisfaction. Discusses the best practices in management accounting circles. And then finally, non financial indicators for fraud detection. So, academic research supports using non financial measures for fraud risk assessment, like decreasing employees alongside increasing revenues, signal potential fraud. Non financial indicators are harder to manipulate than financial numbers. Some industries, like airlines, verify non financial indicators independently. Comparing financial and non financial measures enhances fraud detection effectively. So, this completes the third video on financial statement fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.